Michael Williams, Managing Director of the Hopkins Group and one of the Senior Financial Planners. I'm also one of the founding members of the Hopkins Group Investment Committee. I'm sitting here today with
Mark Wenzel, who's a Senior Financial Advisor with the Hopkins Group. I'm also on the Investment Committee. As part of my role as well, I produce a podcast interviewing investment managers about the investments that they're managing on behalf of the managed discretionary account portfolios. So this is a monthly update and we're looking forward to sharing more details about the MDA with you.
Interesting month, January. This is not the usual January that we would see in markets that we're used to.
That's right. So I write the monthly report also for the email, and certainly in that research I found out that there was the fourth worst January since 1960, which means obviously that it's unusual in terms to have such a negative January, but there were certainly obviously prevailing factors which caused the fall during the month.
And those prevailing factors, what are they and how persistent do you think they will be in market performance moving forward?
Yeah, absolutely. I mean, clearly the big one was the expectations for inflation significantly increased during January and certainly before. Obviously, there was printed in the US that they had over 7% inflation annually, which scared the markets, with the expectation that that increase in inflation will see a significant increase in interest rates. And with that, the high-priced, low earnings, if you like, companies, particularly, the technology-orientated companies, had a significant fall, and you've seen falls also in other assets such as Bitcoin, and that sort of moved the markets down lower during the month of January, primarily, as I say, due to the fact that interest rate expectations have increased, that they expect more interest rate rises than they did towards the end of last year.
And it's not always the case that interest rate rises mean a downward market, is it?
No, absolutely not. So generally interest rate rises are a really good thing because it means the economy's performing well, there's full employment, businesses are performing well and looking to expand, are spending money on investing back into their businesses. So generally it is not a bad thing. It is a sign of strong economic growth when interest rate rises. Obviously, in this case, we've had unusually low interest rates for a long period of time during the COVID stimulus, which is obviously resulting in some of these increases in inflation. But generally, interest rate rises mean strong economic growth.
And as the profit season's starting to wrap up here in the US particularly, how have you seen profits for most underlying businesses?
Some of them have been really good. Obviously, those that have missed have been poor, if you like, but and they've fallen. But generally, economically and business performance has been pretty good, here in Australia. So it's still pretty early in the reporting season here in Australia. But you've had reports from companies like Microsoft and Amazon in the US, which have been really strong. And then you've had sort of some individual issues with a company like Facebook, for example, which has been significantly impacted, and that sort of pushed the markets down and created a bit of a scare. But generally, the strong companies have been performing really well and delivering sort of beyond expectations.
With the strong equity returns of last calendar year and the inflation uptick not being a complete surprise, we started to see it happen with supply chain and wage pressures.
Yeah.
What were the changes that we made to the portfolio in advance to effectively protect from the sort of situation we've gone through in January?
Yeah, absolutely. I mean, I think that's the key point. So we've sort of had a few questions from investors asking, what changes are we going to make? We made significant changes back in October, November, around the portfolio, moving money away from both international and Australian equities into more private equity investments, which continue to perform really well. And then also we moved a little bit of money away from Australia to be more international. And again, under that scenario, we allocated more to value-orientated companies, which have been performing better, during this most recent downturn. So we have made some changes which have been positive for the portfolio in the shorter term, and certainly, expect that to continue on from the longer term perspective.
And we obviously debated there for a while our gold holdings, which had underperformed last year in comparison to equities, but they really came to the fore in the last 6 weeks.
They have. The gold's performed really well, and also the gold companies that we've had in the portfolio have been fantastic. So, I mean, again, probably one of the benefits of being part of an MDA is that we can allocate to the gold and to the gold companies within the portfolio as a risk protection measure, and they continue to hold firm. And again, generally seen as a really good in-store of value when there's a higher inflationary environment.
And the changes that we've implemented this month in the investment committee, and highlight to what's been going on in trying to balance out that risk versus return chart. Could you give everybody an overview about what they were?
Yeah, so we had a pretty fierce sort of debate, I guess, in this month's investment committee about what was the right course of action. So we have increased the number of managers within the Australian equities part of the portfolio, and that's meant that an introduction of Alfinity Australian Equity Fund, and that has a bias, I guess, towards more value orientated investments. They do have a large exposure to financials, so banks and other financial institutions, which again, should be defensive when interest rates are rising. So again, we've added a little bit more protection by having a greater diversification and more exposure to interest rate sensitive sectors in the Australian component. We also took a little bit of money off the IC Small Companies Fund and allocated it to the Novaport Microcap Companies Fund. So I just moved a little bit more money into microcap stocks, which we think represent good value, and again, should company by company should perform really well even when interest rates are rising. And then in the international, we debated pretty fiercely about adding another fund, but decided against it at this stage, wanting to see what reporting season brought in the US and obviously what reporting season brings here, and that's a change we may look to do. Again, just trying to add some more protection by being more diversified. And then in the fixed interest space, given the expectations of interest rate rises, we moved part of the allocation to fixed interest into a floating rate environment, which means that as interest rate rises, you get the benefit of those interest rate rises quarterly, effectively, by moving into more hybrids, which produce really solid income and will, obviously protect the capital and not be impacted when interest rate rises. And obviously, that's the expectation over 2022.
Yep. And the remainder of 2022, are you feeling confident? Got to keep an eye on the volatility. We'll be regularly reviewing it more regularly. What do you think the outcome's going to be? Yeah,
it's always difficult. I laugh at this time of year because there's so much noise around and everyone's making predictions about what's going to happen this year. But, you wouldn't expect as strong a year as last year in terms of equity market performance. Mm-hmm. But I think, that, again, as we talked about at the start, the economic fundamentals are really strong. Even if interest rate rises are coming through, I think you're going to see really strong earnings. You've obviously got a lot of growth coming through the system. You've had a lot of investment back into supply chains and sorting those issues out. So I think ultimately over the year that inflation will come back under control, back to a more reasonable level that the central banks are comfortable with. So from that point of view, I think there will be volatility, but inflation won't get out of control, as people are saying, and that equity markets will continue to perform strongly throughout 2022.
Mark, great update. Thank you for that.
Thanks, Michael.
And we're looking forward to seeing more people back in the office now that things are starting to return to a COVID normal. Thank you.
Thank you.